Ladies and gentlemen, it is time for one of my favorite segments that we do. We do this once a month, and it is called our strategy session. This is where we give you a backstage pass as to what some of our members of the trading team are thinking. We come up with some of the themes and key ideas that we're going to be focused on over the course of the next few weeks, and therefore I'm going to welcome in a big part of our trading team, event trader, blue chip trader, scalp trader, and chart trader. Good morning, gentlemen.
Good morning, Jim, or afternoon,
Good morning,
I
Jim.
suppose we're getting into too, right?
Yeah, depending
Yeah.
on where you are. I tend to like to start with Brett because I do like to go from a top down and work our way down into some individual equities. And so a great place to start with that is with you, Brett, aka Chart Trader. And so I'm looking at the markets here, the equity markets. And yesterday we touched the 200-day in the S&P. Kind of looks like we may be on the verge of another test. So, in the concept and the landscape of where we are in the equity markets, where do you think we're headed from here?
Okay, so I recall that I have consistently been looking for 2775 in the S&P, and that's not just because of the 200-day average, but it's also because of a line that I had drawn on my charts from way back that I felt like has been so consistently important for the market that it would continue to, build up a kind of gravitas in terms of traders. And it goes actually off of the early 2018 highs and cuts through the trend of midway through last year without doing much, but then serves as the basis for a triple top in October and November, where every time the market just moved back up, touched that line, turned back down, and then we got the December crash. And then when we got this recovery rally this year, we came up to that line and stumbled at it for about 2 weeks before pushing through it, and now we're coming right back down, and we've touched the top of that line. It's a shallow slope that goes across the market from early 2018 highs and right to basically perfectly to yesterday's low. I think we dipped barely underneath it. And the reason why I was looking for this level is because that has confluence with the 200-day moving average and also a line that I had during the correction from early 2018 that served as kind of a fib level and midpoint, range midpoint area when we were chopping back and forth violently in early 2018. It was kind of a critical point. This 2775 area as a flat line, as a price level, was important. It's also where the 200-day is, and it's also where this important sloped support is. So there are so many points of confluence there. And it also serves as that kind of perfect little overshoot. We got that low in early May, and then we get this sort of bear market bounce situation, which I think you did a great job of picking out. And then we roll back over, and it's nice to get that kind of flush out, where you get the weak-handed money out, you flush down through it, you get to the more important level, and then you start to bounce. And it's kind of got this perfect sort of classic correction low feeling to it. But it's also, I think, really almost too obvious right now, and so maybe that's kind of added to the fact that we've got popular statistics about a lot of short interest in the SPY. We can see that there's a lot of pessimism in the sentiment data, but not a crash watch situation, and we don't have a big spike in the VIX, which is another little bit of a warning sign. So there's a lot of things to me that suggest the possibility that we have what I would call a discontinuous sentiment situation, which means we have the possibility of getting little pockets of weak-handed optimism inside of what is going to be a persistently kind of pessimistic sentiment context right now. And it offers little opportunities like the short that we had today in the NASDAQ, where you get this sense of maybe a lot of people who've been bearish and they come in this morning and they start to get some research notes and they start to add it up and they're like, whoa, this could be the low, and they take off all the hedges and they jump back in. But it only takes an hour or two for that conviction to start slipping, because we've been through this for the last few weeks. We've been through this feeling of these moments of hope that gradually slip away, and the problem becomes this kind of, here comes the opportunity, and then, it's starting to fade, and I've gotten hurt that way a few times, and that type of conviction gets harder and harder to sustain. And this sort of environment, in my experience, offers a lot of little scalp short opportunities, even if even if it ends up being an important bottom. And it really depends on your time horizon as a trader. And I think there's a lot of people who've got to kind of force themselves into a situation to say, this is my system. This is an opportunity on the long side. I need to have no stops in place. I need to get long now because it adds up as this type of classic bull market correction that's hit a classic kind of correction bottom situation. And I need to just get in the market and set it and forget it and not look at it too much. And if you're chained to that kind of system, you can't take advantage of maybe all the little interesting scalp short opportunities that are going to be woven in this pattern for the next week. So it really comes down to what your strategy is. My strategy is that I've got an unleveraged long side investment holdings portfolio in the market. I've had it for several years where I don't look at it, I don't think about it, and it allows me to take shorts in this type of situation because I've already got some exposure on the long side. And other people, your strategy is going to be, this is when you have to position long. Somebody like maybe a Tech T is in that position right now, and some other investment managers that I know. This is about trying to make sure that this is when you load up on the market. So it really comes down to your time horizon and your strategy, and there's going to be different scenarios for different people. As far as where we are, I would say there's a classic correction bottom possibly in place right now, but there is a warning signal to watch out for. And so I want to explain what that is, because if you're in that other system where you need to take advantage of loading up your portfolio right now, here's what to watch out for to get worried. Try to keep that discipline, but I'll tell you, in November and December, there's something we highlighted as a big risk, and it ended up being a crash position that we were able to put on the short side. And that risk was you get into a situation where it all adds up as kind of a minor correction low, and you get the negative sentiment in place. You get a big negative extreme. You get a lot of caution in the market, and then what happens is you just spin your wheels. The market maybe moves sideways in a chop for 7 to 10 days. You get a couple spikes to the upside. They're quickly given back. And you get in this situation where after getting that negative sentiment extreme, you spin your wheels and you start to pick up all these bullish sentiment signs. And the market really hasn't made very much progress to the upside. That's the warning sign. If you see that, you want to get out of those positions, because that's when you get the trapdoor. So if everybody starts to you start to see the sentiment signals of a lot of bullish signals, a lot of bullish sentiment surveys, the hedges just leak right out of this market, but we haven't made a lot of big upside. And you just are tracing kind of sideways in a choppy range for a week to 2 weeks, and then you start to move back down and test supports again. That's when you get a kind of trapdoor. That's what we saw in December. So I would say if you want to play the longer-term position right now with the idea we've seen a classic correction low yesterday, then I think that's really what you want to watch out for as the possibility for things turning nasty. And obviously, China is the catalyst right now for that possibility.
All right. One question regarding the sentiment data. Is it possible that we see a very modest-looking sentiment, similar to what we saw on the upside for many, many years, where you never saw any types of extreme, but there was really no reason for anyone to think that we would go down? It was a very by-the-dip, methodical type rally. We would just continue going up. Very few outliers as far as the data goes. Now, can you get the same thing on the downside historically? Has that played out to be something that can continue on, and there we just kind of get a slow drip lower?
Well, okay, so it's slightly that way, yes. And so there's the difference between the wall of worry and the slope of hope, and there's a kind of similar situation. But I would say I look at it a little differently. With the upside and looking for bullish sentiment extremes, I really look for massive extremes in bullish sentiment. And when it falls short of that, you can get this exactly what you're talking about. There's something where they can just sustain itself. And there's an asymmetry to the market, so it's not going to be perfectly symmetric because so many more market participants are long than short. Mm-hmm. It's like a 90-10 ratio, so it really is somewhat different. What I would say, the way that bear markets tend to progress is you get a bear sentiment extreme, and it does just exactly what I just described, where that bear sentiment extreme works itself off. You get a couple spiky rallies, but they can't sustain themselves, and the type of action to the upside is spikes on the upside. The type of action to the downside is grinds to the downside. And when you get a spike to the upside, grind to the downside, spike to the upside, grind to the downside, but you haven't made new lows, and that bearish sentiment extreme just gradually goes away. in the context of that, you're starting to see that the spikes and the grinding to the downside is doing the work of pulling in a lot of more what we from the short side might call sucker money that's then vulnerable when you start to go back through those lows. And that's sort of the fuel for that next leg lower. And bear markets tend to have that kind of progression. You get headlines, spiky rallies that offer a new hope that everything's going to be fine. You reset the sentiment of the market. You reset the sense of vulnerable money in the market, and then the kind of distributive ceiling is still on top of things, and you gradually roll back through. And when you start to hit those new lows again, you hit them without a bearish sentiment extreme in place. So you need to then, get back to a bearish sentiment which is going to be at significantly lower prices. And the trend just kind of tends to go along that. I'm not saying that's what's going to happen. What I'm trying to do is provide a roadmap for people to be able to maybe warily enter on the long side, so they feel like, because I know I have some contacts who just got absolutely burnt to a crisp in December because we had this kind of situation. We had a lot of obvious technical signs. We had some technical systems out there, people who write, real high-end notes who were coming out with, hey, this is it. This is when you need to load up. Everything is all systems go. And when we went back down through that December low and we really turned into that panic to the downside, there's a lot of people I know who really got destroyed. And I'm trying to help people be able to position for the possibility that this is that kind of garden variety corrective move in the market that you need to take advantage of in a bullish trend, and still avoid that kind of pain. You're going to get a little pain, but avoid the real deep drawdown if it turns out that that's wrong. And the way I would say to do that is to watch out for this healing process in sentiment that doesn't involve a healing process in market price. And then when we press things again on the downside, you're going to lose that healing in sentiment, and it's going to come at much lower prices.
All right, let's jump over to the bond market. And one of the things that I found interesting, Chart, and I know you're all over this, it just caught my attention today, is just how much more negative the German Bund is relative to the JGB. I just naturally assumed that the JGB would be yielding negative percent. I didn't realize that the Bund would be yielding even how would you say, greater negative percent. It's just mind-boggling to me.
Yeah, it's awfully interesting, and I think Japan has tried to do more control over their curve than, and I think the ECB is basically, I mean, they had the Wu-Jia. I think we've talked about the Wu-Jia shadow rate. Do you remember that conversation?
Yeah, I mean that was a while ago. Sure.
Yeah, right. So the Wu-Jia for the ECB got down to like negative 5.3%. So they have done a synthetic negative rate that I think is deeper than Japan, and I think that part of it is because the market is figuring that in. So it's I mean, their policy is effectively set at a deeper negative rate. Okay.
Well, let's talk about the U.S. bond market, and I'm going to pull up a TLT chart because we are now pressing pretty close to new highs once again, and just let the listeners get us up to speed. Are we officially in inverted yield curve territory still?
Absolutely.
Okay. So now with that said, how does that play into your overall theme of a correction and maybe a recession?
It really doesn't to me.
Okay.
I mean, I think that there's I think that people really don't account for the fungibility of the bond market enough. And I know that there's different views on this, but I think that at this point we've seen relative lack of volatility in the currency market over, let's say, the last year and a half. It's been dollar higher, it's been pairs lower, but the volatility, we have not seen spikes in movement, and that suggests that forward rates on currency hedging aren't quite as pricey, and that allows people to gradually adapt to systems where they borrow in Germany and lend to the U.S., and that's just going to tie rates together. It's just going to bind everything together. So you see policy set in Europe for something that's effectively or synthetically at negative 5%. That's going to skew what we're seeing here in the United States at the long end of the curve. So I don't think that is necessarily, and I know this is it's different this time kind of statement, but honestly, I think with the Treasury market, given the QE that we've seen over the last 10 years relative to the grand sweep of history, I don't think this is comparable to what you saw in, say, 1982 or in the 1960s. I really don't think the signals from the bond market can necessarily be treated as part of the sample that analysts consistently use to say, this guarantees a recession in the next 4 quarters. Maybe it does. That may happen. But I think that you can't just take a face value read on the yield curve given the level of manipulation that's come in from central bankers.
All right. Now, you did bring up currencies, and there's one in particular I want to bring your attention to. We've been talking about the euro, usually a little bit when you come on in our Trader Talk segment, and I do have a weekly euro chart up. Let me see. Let me get that. All right. So last week we identified the move in the euro. Yeah, we put in a low and we came back in. So now I'm looking at a weekly chart, and we highlighted that eat the tail type trade on
it's there
in a weekly chart. It's getting there, isn't it?
Oh, it's there.
Okay.
It's there now.
Okay. So we.
I don't know what I'm doing. Not short the euro. Right now as we're talking.
Yeah, but every time I ask, every time I ask
you should be short the euro. Everybody used to be short the euro.
Yeah.
Yeah.
So I mean,
there it is. That's the signal. I mean, the weekly chart's exactly the right thing to point out. It's another big tail hold, and then we just go right back down through the tail. Mm-hmm. And, it's just not healthy looking there. So, yeah. And what does that mean? And the further thing is, what does that mean if we are seeing, is it flight to safety money coming into the dollar? I mean, does that change that? I don't know. I need to think about it more. But as far as that setup and that idea that we've got a grinding trend. I mean, it's that escalator too. If you look at that weekly chart, what an escalator. And it's just, there is that guy walking on the down escalator in an upward direction slower than the escalator's going down. Mm-hmm. And it's going lower, and every time it just keeps making all of these tantalizing little doji bottoms over and over and over again, and then grinding back through them. And eventually, that sort of thing, generally speaking, leads to an acceleration to the downside, in my experience.
All right. So just highlight a couple of the risk factors that may be in play over the next month in case we do see a fallout in this euro.
Oh, what do you mean?
Well, I mean, we got the Italian budget, but I don't really know the timeline of all these. I don't know.
Well, I mean, the Brexit situation is big. The Italian budget situation, I don't know the timeline either.
Okay.
Gavin will be up at some point here, and Gavin will do a better job at this part of this conversation. I mean, I think that it's policy. So what I would say is we're starting to price for a September cut in the Fed. And so I guess if that gets out of the Fed funds futures and becomes general consensus, then maybe that weakens the dollar. So,
all right. Well, that would be bullish for the euro, though, right?
Well, that's what I'm saying. That's the risk factor. So I thought you meant risk factor for the short. Like
no,
getting short.
No, I meant for the currency in general. So that people could look out for, some warning signs that says,
that one then.
Yeah.
Yeah, here that one is strong U.S. data.
Okay.
Like something, the inflationary risk in the U.S. That would be it for the euro. Inflationary risk in the U.S. Like, hey, we see something, a big CPI number, that would do it. I mean, it was something that constrains the Fed from easing. You're taking that cut possibility off the table in some way. I mean, the Treasury market is clearly making that look like a ridiculous idea. But again, there's the fungibility issue that we just talked about. I think the Treasury is working on an international basis. So, I mean, the euro, I think, is holding on by a thread by the idea that this is the sense of divergence between the United States and Europe in cyclical terms is going to end. I think that's what would be the long thesis, because the long thesis in the euro in this pair is a short thesis in the dollar. You can't really disentangle the two. Mm-hmm. So the idea would be that this is something that's becoming just as much a U.S. problem as a European problem. And the idea that you have divergence accelerate, the U.S. is actually showing reaffirming strength in the midst of continuing signs of a inexorable progression toward recession in Europe would be, that acceleration on the downside in the euro.
All right, so I think that's a good place to bring in Gavin, and we can hand the ball right off to you, event trader, aka Gavin McGuire. And are you familiar with some of the some of the big key events that we should be looking out for as far as a timeline goes, Gavin?
For the month of June?
Yeah, in Europe in particular is what I was talking about.
Yeah, next week's the decision from the EU whether or not they want to put a 3.5 billion penalty on Italy for its 2018 budget, and I think that's going to be a very key instrument in which direction the euro goes. If that comes and passes without any sort of a fine, I think you could see a little bit of a temporary rally in the euro, which might provide Brett with that entry point there. So that's one thing I'd be looking at. The other big thing for me is the G20 meetings coming up in June, where we got the finance minister meetings on the 8th and 9th, and then the leaders at the end. I think June 28th is the date. And that's one of the reasons why the last 2 days I was looking for this 200-day level to hold. We could go back to the April 30 strategy meeting, and we were talking about it at that point. The big question, as you could see in the strategy key minute points, was will market money managers continue to sit underweight in cash or get sucked up into a melt up? Recall the S&P was up right around that 2950 level that we were talking about. And one of the key things that I threw out there that I didn't think that the market was taking into consideration is when we were looking at valuations, I felt that there was way too much emphasis on a second half recovery that was going to become more and more difficult as we ran into some of these negative trade headlines. And certainly that's started to come to fruition. In the month of May alone, we've seen 6 downgrades by analysts at Apple, and we're really starting to see that come into play. We've seen some lower guidance start coming through from the different players that have been reporting, and that's going to continue to lead to some downside valuations and some tweaks to estimates going forward. And that's going to continue to weigh in on the market. Now, we're coming into some pretty key support levels here, and I think you have to take into consideration that G20 meeting where there's still a hope that some sort of deal could get through. And we also know that there's a little bit of a Trump put out there on there, right? That if the market was to start really selling off aggressively, then you could see the president come out saying that he's talking with Xi, and they're talking about a meeting there, and I think that'll be enough to kind of keep a bottom in this for the next couple of weeks. Now, I'd be in Brett's camp that I think that that's going to prove to be a little bit of a foolish investment thesis there, as I think fundamentally the two sides remain pretty far apart, and we're seeing that continue to play out, and it looks like it's really going to seep into that 2020 election cycle there and play a pretty large role in some of the rhetoric that's going to make it a little bit difficult for us to really find some stable footings. So for now, as I said, I see a little bit more of a choppy pattern being formed out because of that G20 meeting and that little hope that we saw, similar to what we saw back in November. Now, somebody had postulated last time I was talking about this that the Fed's in a different position. I completely agree with that. With that in mind, we are seeing some clarity headlines passing as we're talking here, and I think that's going to play into the market where the Fed isn't showing any signs of moving here. In his comments, he continues to look for inflation weakness to be transitory, that they're watching for a persistent shortfall, and I think we are going to slowly see that play out in the data. And the market's going to have to kind of take that into consideration, which I think is going to act as a little bit of a support level, but overall the weighting is going to turn out to be a little too great when we start seeing some of these second half numbers coming in and the guidance come in Q2, which will start following about 3 weeks after that G20 meeting. So we don't see, I'd see us being able to hold support and seeing a little bit more of a sideways chop until we get a little bit more clarity on how that G20 is going to play out. But if we see that fall out with no deal, and then some of these Q2 numbers coming out a little bit weaker and guidance of that second half recovery failing to come to fruition, then we can start really getting a little bit more of a shakeout on the equity side here. Certainly we're seeing it on the bond side here, which is no surprise, but they are 3 really large items that we got to keep an eye out in June. In what's otherwise a relatively quiet month, we'll certainly be keeping an eye out on any sell-side conferences that are coming across as we get closer, looking for an update on guidance. But we're really starting to see some of that lowering of the second half outlooks playing in. And if we start seeing that play in with economic data as well, which has remained relatively stable. Certainly the ISM numbers from last month, a lot of people are going to take hold of that, and they are out, I believe, on Monday. So, that's going to be another key item for us to keep an eye out on. And, Brett and I will take another look at the sentiment data. We've talked a lot about how some people are pretty well hedged, which, again, I think gives us a little bit of a short-term bottom and a chance at a chop. But as Brett was saying, we see sentiment kind of improve a little bit and just a failure to really get any meaningful bounce back up towards those highs that we're seeing in April. And then we start getting a failure of the G20 meeting and some of those Q2 earnings reports falling short, and more importantly, that second half recovery failing to take root in the guidance, then, we could see a little bit more of an aggressive downturn.
All right, and those Clarida comments coming in, and we got a small little knee-jerk reaction off the lows. I think we moved up 3 or 4 points. So I don't know how sustainable whatever he had to say is, but at least we did bounce off the daily pivot for now. So I guess we shall see. Just a quick update. S&P futures are up 7 points now, and NASDAQ, they're still up 27. The NASDAQ futures are. So Gavin, one of the things that I noticed today in your own portfolio is you did a lot of cleanup. Any particular reason?
Yeah, somebody was asking me, should we be reading into that? And I think I just kind of laid out the reason right there. I'm short term right here. I am a little bit more bullish. Perhaps I could have waited a little bit longer to chisel out some of these positions, see if I could get a bounce back. But, I'm looking to lighten the load a little bit here and keep some dry powder on the sidelines for some potential buys. Here's a few other names that I'm watching here. I noted that Citigroup and Bank of America with the rate concerns going forward, that's an area where I could be looking at trimming a little bit more. Perhaps some of the tech space like the Broadcom AVGO, that's another area that I'm keeping an eye out on here, giving up some gains there. I still like building in the Intel area. I'm with Scott on that in terms of I think that's a good long-term position. A name like Disney, I think that's going to be a safe haven play here. You'll see a lot of the names I have in there paid nice dividends, so I'll still get some income even if we did get a little bit of a pullback. But yeah, I'm a little bit more cautious on the overall market play out here. I think that we could be in for a little bit of a difficult chop going on in the front here, but I'm cautious as we get a little deeper into the summer and as we get past that G20 meeting and we start seeing some of the real headlines from the trade wars impacting it. And that's going to be in some of these bigger names that are just going to have a tougher time planning for the back half of 2019 that have been talking a lot about expecting recovery in 2019. That's simply not going to come into fruition. So that's kind of how I'm approaching it. I think it was evident in some of the moves I took in my longer term portfolio here and some of the things that I'll be looking at in the coming weeks.
All right, Gavin. And just out of curiosity, I know we're going to be heading into the end of the quarter for June. That'll wrap up Q2. And I'm just curious, how frequently do we see new updates from these conferences where they update guidance? Is that something that's going to be a real type of catalyst that we should be on the lookout for every day? I just can't remember how frequently they actually do that.
Well, it's hit or miss, and I mean, usually, you got your conference season that happens right after the earnings season, which isn't much of an impact. Usually runs 2 to 3 weeks after the main names have come out. We already have a fair idea of what's going on in the business world and the corporate side of things. But as we get closer to the end of the quarter and into the middle of June, and some of these sales sell-side conferences start coming in, and we get a little bit more of what the linearity of the quarter is and some more updates on what people are expecting. That tends to have a little bit more of an impact on the corporate side. So, we'll start seeing that pick up towards the end of June, and that's something that we're really going to want to keep an eye out on this time around. Sometimes we get the updates that we want, sometimes we don't. There's no great way of measuring it. It comes and it goes. But it's something that people are certainly going to be looking for in terms of the tone as we get later into June, particularly with those big macro events in the backdrop too.
All right. Now, I'm going to bring in scalp trader Damon Southward. And Damon, today was one of the few days you weren't all that particularly active. All week you've been pretty busy, especially yesterday. What are the type of things that you're seeing and keen on as of late?
So as I've noted in my recent comments, I'm running a pretty light equity portfolio on the long side. On the short side, I've been trying to identify some names such as BYND. I want to buy puts on it rather than to short it as a swing. Don't want to swing short this name at all. But every day I come in and see where the puts are trading on this name, and they're just so rich right now. So I hope it stays up here so that maybe some of the vol comes in on the puts, because I just don't, I'm not a believer in this name. I think there's going to be a lot of competition coming in. It's pea protein. You're seeing a lot of pea protein type of products that are out there now. So I think this is going to be a $30 or $40 stock within a year. And if I can get puts at the right price, I'm going to be all over that. So it's actually one of my most compelling opportunities that I see out there. I'm looking at a few Chinese names like YY is coming off a really good earnings report. A lot of the Chinese companies have been noting that the ad rates have come in, and as well as the Chinese consumer has been pulling back. But YY actually does, I think, the majority of their business outside of China, and it's still growing pretty rapidly. Huya is esports, which is still growing at a pretty dramatic rate. So I like the valuation on YY. I think the valuation is super compelling, and I think Huya is one of the few remaining growth stories coming out of China right now that isn't directly being impacted by I think they're outgrowing the pullback in the Chinese consumer as well as ad rates, just because that business is so strong right now. Other area I'm looking at is yield. I think that with the 10-year back down to I think 2.25 now, or somewhere around there, a lot of these preferreds that we own that have yields of 9 to 10%. Even though they haven't been actually going up, but just because the market has been coming down and there's kind of been a risk-off mentality, I think some of these things could really break out to the upside, climb substantially above par. There was concern that, the rates were going to run away from us here just a few months ago, and now we're going to, we're 100 basis points or more off of the recent highs in the 10-year. And I think some of the portfolio holdings that we have right now are just super compelling, such as the NGL Preferred C and the DCP Preferred B. Both of those are trading slightly under par, and I think they could have 10% upside potentially, given the yields that are being presented by those right now. Also like the TRTN Preferred A, which is trading above par. I think we bought it right around par, and it's probably about 5% in the money. But I think that one actually has some upside as well, given the qualified dividend aspect of it, as well as the high distribution.
All right. And then as far as some of your day trading ideas, I know as far as your portfolio, it's a little light, but you have been very active scalping around, huh?
Oh, Jim, I didn't answer your question, huh?
Yeah, that's okay.
Initial question about
That's
day
okay.
Yeah, so, basically I'm just coming in every day, just seeing what's out there. I'm not bullish, haven't been really bullish on this market for some time, so I really just look at what the setup that's being presented that day to determine whether I want to go long or go short. Not really putting on much on the swing side, just looking at intraday volatility. And unfortunately, I mean, some of the days, like today, for example, it just feels dead. And I see, even though days that I'm not trading, each one of our team members has something going, right? And so I think that's a real positive aspect of the service. Like if someone might be not running a lot of positions, have a lot of positions to highlight, but someone else, maybe we'll have 6 or 7 trades even on a slow day. Well, for me, it's an absolutely slow day. But most importantly, I don't feel compelled to trade. I think this today is an example of the practice of patience and discipline. This is not, in my opinion, a great trading day. And I think as we enter the summer, you have to pick your days. You have to recognize that, maybe 2 days out of the week are going to be pretty dead, and recognize that, and really find compelling opportunities to force you off the sideline. But I'm starting to turn slightly more bullish in general, and so I'm hoping to see a little bit more downside, some type of flush here to kind of get me back into some positions at more compelling levels. One of the names that I'm interested in is DCP, David Charlie Paul. We own this one already, but it's a MLP, about a 10% yield. I think it has price upside. So, you know me, Jim. If you give me a 10 to 30% yield, preferably the 30%, but anything in the double-digit yields that I can get paid to own that also offers upside. I love to have those stashed away in the portfolio, because it makes times like this a lot easier when you're picking up that distribution check every quarter or every month. Some of these guys pay monthly. It feels like you're still in the game, even if your portfolio isn't running 100%. I mean, I think right now I'm probably down to running at 35 to 40% on the equity side from where I was just a couple of months ago. And most of those positions really are yield-focused type of plays.
All right. Looks like Event Trader just went out there taking some profit in GOOS. This is one that you put on a little earlier today, so just taking some off the table. Gavin?
Yeah, it hit one of my first targets, so keeping an eye on this to see if it can't get edging back up closer to the 40s, but wanted to lock something in just because it can be a choppy market out there. So.
All right, and then you moved your stops up as well.
Yeah, edged that up just at 33.50 level.
All right. Yeah, that one looks good so far. All right, so that brings up Blue Chip Trader Scott. And I have to say, you've been navigating through this market like a slalom skier, man. I've been impressed with the way you've handled both long and short ideas. You always say you're getting lucky, but let's call it what it is, man. You're pretty good at this game.
Yeah, I'm changing my name. I don't want to be called Blue Chip Trader anymore. I want to be called Beyond Meat Trader.
Okay.
So you just start calling me. You can just call me Meat for short.
All right, Meathead. So this one is very interesting. Damon's looking at this one. He's sizing up some puts in this one, but you've tried to play both sides of it. I guess we'll start with this one as far as how you're thinking of this one going forward.
All right, so this is the madness of my mind here. So it made its debut. I think we said the IPO price was supposed to be somewhere around 25, right? And it wound up opening at 45, ripped up to $70, and then it just continued to grind higher here while the rest of the market was underperforming in May. And whether it's just day traders just sinking their teeth into volatility and a high short interest name, or for whatever the reason, the stock technically has been a 45-degree uptrend. 5 days up, 3 days back, 4 or 5 days up, 3 days back, and now it's 4 or 5 days up again. It's just a definition of a staircase uptrend that's been in play here. Now, to describe the current conditions of this market, I was short this stock just 2 days ago, and with that 85 resistance level that I was just banking on there, it looked like a potential top in the market, and with everything breaking down in the major indices across the board, it felt like this name had some downside movement if it was going to crack underneath $80. Sure enough, we had some initiations come out there. Most of them were pretty neutral, equal weighted, but then you had JP Morgan coming out there with an outperform, I think it was, or some sort. And that basically gave it the juice to have the squeeze come back up over the $90 area and stop us out. Now, the key here is, and this is the beauty of trading, as a trader, you shouldn't necessarily have such a strong commitment to one side. You have to be flexible enough to admit that you're wrong when things go against you, and then take that signal as a potential turning point and then get involved again, perhaps from the other side. And that's exactly what I did yesterday. The stock was holding up pretty darn well there above $90 while the broader market was under pretty heavy distribution yesterday. And I went out there in the afternoon before the final hour and said, if this thing clears 93, it's worth a shot. The trade is to take this thing long over $93. And sure enough, it broke out through 93. I jumped on board, small size, because it is a highly volatile IPO, risking about $2 or $3 on the trade there. And they just took this thing and ran it right up to about $97 into the close. So I wasn't going to look a gift horse in the mouth by any means with that trade. So I wound up taking off a small, portion of that trade before the close, and then I held some of it overnight because I told myself, if this stock was ripping higher with the broader market weak, if the market was going to get some sort of reprieve from selling going into month end, then like I said, if it's going up in a down market, well, what the hell is this going to do in an up market? So sure enough, futures are a bit higher today, and this thing was pre-market trading 104s. And I don't typically get involved or trade pre-market, but this was a concern overnight for me. I was basically, when I went to bed last night, last thing in my mind was, what if this thing gaps down tomorrow? Like, what if there's just some massive drop in the market? This thing could get smoked, And then I wake up this morning, I see a pre-market 104. That was just another gift, and I wound up and just banked the rest of that profits pre-market. So that's basically that. I think that's a summary of how this market, how you have to approach and trade this market. You have to have this light trading approach, and you can't really sink your teeth into aggressively being short or long any individual name, because honestly you just don't know which way it's going to go any day. Now you can look at the key technical levels and try to find an edge, which is of course what we're always trying to do, find low risk, high reward setups. But given the overall conditions, the VIX spiking, the headline risk, just the overall major indices dropping back underneath their 50-day moving averages, some of them even probing and challenging the 200-day moving averages. You have a handful of the sectors, usually the riskier sectors like energy and technology and industrials and transports. They're all starting to roll over down to 3-month lows and whatnot. And you have more of the defensive groups like utilities and staples and REITs holding up. So it's just this dynamic and this, I hate to say bearish, but it's definitely more of a pullback corrective type of move that's been in the works here. I mean, the writing's been on the wall for a couple of weeks now since May got underway, and you have to make that sort of adjustment as a trader to survive. It's just that simple. So.
All right, and as far as where you get ideas from, why don't you give the listeners a rundown of your go-to source?
Yeah, sure. So the one thing great about our site is that even when you're, whether you're cutting back or not, there is just a plethora of ideas everywhere on our site. So, I mean, most people, and including myself, I just camp out on the duo in-play page, where I have headlines coming down the left side of the screen, and then on the right side, I basically have all my technical trading-oriented stuff. So that's the key focus there. When commentary comes out from each individual trader, when the market briefings under TalkX come out, or any sort of economic events, I'm always looking for there. I also like to look at a lot of the story stocks that come out as well. That's a whole group of analysts at briefing that do a little bit of research there, and kind of gives you a quick hit on a particular sector or why a stock is moving in response to a headline or earnings of sorts. So I always look at that as well. But then to dig a little deeper for more of my, coming up with focus lists and what charts to focus on for ideas, I am a big proponent of the liquid momentum focus list. You can just go underneath that investing and trading drop down at the top of the screen. Midway through there, right underneath technical analysis, it says liquid momentum. And this is one of our proprietary scans that are run each week to identify the most liquid, more volatile leaders in the market based upon their relative performance. And right at the top there we have Amazon, Microsoft, Facebook, Disney, AMD, Qualcomm, Visa, Roku, MasterCard, Celgene is in the midst of a merger, Adobe, PayPal, Walmart, Twitter, Pepsi, Starbucks, UNP. I mean, the list goes on, but you could basically, this is going to be my names that I know. They're optionable, which I love trading options. They're in strong uptrends for the most part, and they're outperforming their peers. So as a general dynamic with all those components, they can be mostly traded from the long side successfully, greater than 70% of the time. And that's basically always been my go-to focus list. I try not to short these names unless they've significantly rolled over below weekly support levels, uptrends, 50-day moving averages, and etc. The second thing about this list, too, is that they do show the industries and sectors that they're in. So even if you don't like those names, you should be focusing on the sectors that appear there. We have a lot of software names that are showing up on this list, from ServiceNow to Shopify to, I guess Roku can be considered somewhat of a software name. But Microsoft is still leading the pack up there, PayPal. And then once you start seeing the certain sector there, you can start looking a little deeper. And then you find the VEEVs, the VEEVs of the day, and then you find the Oktas and the cybersecurity names like a CYBR, a Coupa, or the list goes on and on. Workday had earnings. That was another one we've been talking about, really strong relative strength. So just all these ideas start flowing just by looking at these leadership quality names, and the opportunities are just always going to be there, especially if you're a long-sided, long-biased trader. And they respond pretty darn well to key technical levels. So that's a key area. If you're looking for a little bit more mid-cap, with mid-cap growth names, obviously the emerging growth focus list, which is also underneath that investing and drop-down, those are a little bit smaller to mid-cap oriented. Occasionally I'll go into some of these names. Right now we have Zscaler, which is at the top of the list there, so that's a nice one there. Coupa is also on that list. So again, this is a plethora of ideas for stocks that are just easy to trade because they're in these strong uptrends and they're showing these leadership qualities. If you're looking for a little bit more, just technically oriented stuff, then I do the TA page scans each day as well, and that's going to be under the same drop down, a little further down, TA scans, and this is just more computer programs spitting out everything that looks like a potential pattern that's developing. It's not some crazy, esoteric pattern that you're not going to be able to recognize. It should be pretty clear, the way I've set up these scans in the past. And it also gives me a sense of just how the market's behaving. Typically, I like to watch the wide range breakouts and breakdowns, which is somewhere in the middle of that table there. And when I start to see the number of stocks showing up on wide range breakdowns and increase, and the wide range breakouts decrease, well, that's starting to tell me that there's a lot more weakness going on in the market here, a lot more distribution behavior. When you start to see more oversold and overbought, same scenario. You're seeing names that are just getting pounded to the downside. So it's a little different when you start to see more of an inside day, inside week, doji day, doji week starts setting up there, because now it's telling you the market's in more of a consolidation phase, a pausing phase, and then there's going to be these breakouts that are developing soon after. Further down, if you're really struggling in this market, I can't emphasize enough to pay attention to the last signal there. It's called Blue Chips ETF signals, which is on the SPY. This is a proprietary momentum signal I came up with years ago. It's nothing ingenious. It's just basically moving averages and where the price is in relationship to the weekly ranges and a couple of MACDs and RSIs and whatnot. But it does a pretty good job at telling you the current environment that you're in. And it's real simple. It's green, yellow, red. When it's green, you pretty much have all systems go to feel confident on the long side because there's a strong trend that's already underway. When it's yellow, it's somewhere in between, the bullish and bearish trends, and you have to possibly pull back in on the reins a little bit and just be a little bit more selective. Maybe start hedging your portfolio a little bit if you're coming off a green signal. And then recently we've switched over to red signals here twice in May. It's gone from red to yellow, and now we're back on a red signal, which again suggests that you should be more focused on, shorting stocks, and you got to be a little bit more cautious about trying to pick bottoms because the momentum is definitely in that favor right now. So again, there's a lot of dynamics going on here, and you really have to, this is where the market, with the increased volatility and all these risks that are out there, this is where it tests your discipline as a trader. And if you don't have the discipline to recognize certain market conditions, pull back on your share size, when you're feeling like you're overcommitting or overtrading, and just kind of adapt and adjust, well, then you're going to get your butt handed to you. It's plain and simple. And that our job here is to really guide everyone through these rough times, to navigate everybody to become better traders and to keep them from making stupid mistakes. And now the tides can easily change, and we're going to be jumping on top of that and highlighting it. But it's really, we've been doing this for years, and we have tons of ideas, and we have tons of experience, and we're sharing our trades with everybody to help them, make a little money here. But also on Trader Audio, we're always talking about managing your risk, and you really have to have that under control, especially when times are like this, when things are going to get pretty much tested to the limit. So that's basically it in a nutshell, and I've been doing okay. Like you said, I like to say I'm lucky a little bit, but I use charts significantly, and I try to avoid people's opinions of what the fundamentals should be doing or what they think it's going to do, based upon the next quarter. And I just look at the supply and demand that's evident on the price action itself, and I just take advantage of those types of setups. And I make a mistake here and there, that's part of the game. But the beauty is not blowing yourself up on that one or two mistakes, and then getting back on the horse and trading things the opposite way to make up for everything. So,
hey Scott.
Yeah, what's up?
Yeah, so and I agree with everything that Scott just said, especially the last couple statements there. But I've got a question for you. So I outlined a sense that you can look at a top-down view of the market right now and get a kind of very classic correction process that kind of had a classic resolution yesterday in terms of the levels it hit, in terms of coming off the lows in the afternoon, in terms of moving higher today. We got some of the sentiment data along the way that kind of suggested too much pessimism. Mm-hmm. We got the overshoot low from the previous low, and we kind of bounced back up off of a lot of really obvious support levels. But I also suggested that just to me it feels like it could be a little too obvious, and it could be that there are some things under the surface that maybe suggest that there may be a lot of weak-handed interest maybe coming in today betting on that, and that could eventually become vulnerable. So I'm wondering, from your perspective, you kind of tend to take a more bottom-up view, but of the market as a whole, rather than just looking at where the S&P is, but looking at different sectors and different leaders and different individual equities. And I'm wondering, from your perspective, if you feel like the way the sectors are setting up, the way that different groups have shifted and evolved through the course of this correction, and the way that different former leaders are starting to act, does this feel to you from a bottom-up standpoint like a classic bullish correction that is coming to an end and we're set up possibly to surge back higher, or bottom up, are those pieces not in place?
I think we're right at that tipping point. I can't give you a definitive answer.
Okay. Let me rephrase it then. So what would you look for to determine which way we tip as the next signal from a bottom-up perspective?
Right. So I definitely take a keep it simple, stupid approach, and I have to go with the 200-day moving averages here. So the S&P did probe it yesterday around 2776. Same with the NASDAQ, and it did bounce back a little bit here. So that's just a highly watched technical tool, the 200-day moving average, along with the 50-day moving average, that any sort of intermediate term fund is looking at. And whether it's a self-fulfilled prophecy or not, if you start sliding below the 200-day moving averages, it just gets people nervous, plain and simple. And we're at that point right now. So what I'm looking for, and I agree, the sentiment levels, they do seem very skewed to the downside. We've been having spikes in the put-call ratio here, suggesting that there's more, bets going out there for further corrective activity. It is this sell in May mantra that's going on, so there's definitely that increasing, get me out type of mentality because the summer doldrums are kicking in. There's a lot to go on and to argue with the downside activity here. Transportation stocks, if you're a Dow theorist, that's starting to roll over to fresh 4-month lows. A lot of these sectors, again, I could just go on and on and on and tell you all the concerns that are out there with the market from a technical and economic and fundamental perspective. And like you said, that could be too obvious because the S&P is only down, 6% off the high, and the Nasdaq's only down 8% off its high. Those are definition of, that's a pullback. That's not a correction. Correction is typically, you're diving 15-20% more or more, and then you're going into whatever they define as a bear cycle. So this is still in pullback mode, in my opinion. We're just and everyone, don't lose context. We had a fantastic Q1 in the markets. We launched off those December lows. The S&P was in a 45-degree uptrend for 4 months. 4 months and it made its way all the way up to new highs. And then all of a sudden, it pulls back for 3 or 4 weeks, and it seems like the sky's falling, and people are calling for the end of a 10-year bull market, et cetera, et cetera. I just think the market is so caught up and with whatever they think should happen, instead of sometimes just recognizing the writing on the wall. So if I had to put, to answer your question again, I'm sorry about the big runaround there. Like I said, I think we're at that tipping point where I think we're going to rally. I think that June's coming around here, and maybe we just undercut the lows a little bit more just to scare out any sort of bottom pickers here. But I do think that there is some sort of June rally coming into the works here. Now, how high does it take us? Is it going to get us back over the 50-day moving averages? I can't answer that, but I do think that the sentiment is growing, and everyone's turning bearish, and everyone's heading for the exits. And it just does definitely feels like that there's going to be a turn in this market to the upside. Now, as for groups and sectors, which I do pay attention to, I wouldn't even say I'm more of a top-down or bottom-up an analyst. I'm more of a middle ground type of analyst. So I look at a lot of sectors. Software sector, that's been a fantastic year-to-date performer, and it's still holding up okay. And there are some chinks in the armor there, but then, of course, we always have a name like Viva come out and just gap up to the upside there. So there's still some pretty good strength out there in a couple of those software names. Insurance stocks, if you're looking at the KIE, which is the ETF for insurance names, we have really good relative strength going on there. Aerospace, we've seen some breakouts in Lockheed Martin, Northrop Grumman, Triple L, the ITA is the ETF there, or the PPA, acting really, really good. The solar stocks, believe it or not, solar stocks, the TAN is actually holding up really well also. So it's another
IQ results today, Scott, were great. So that was definitely a ray of sun in the cloudy sky.
So there's definitely I hate the term stock pickers market because it's what day isn't, but this is more a sector market, a sector pickers market, and I think if you focus on the right names that are leading in the strongest groups, you're going to do okay. Something like energy, I am a bear on energy. First of all, I'm a huge U.S. dollar bull. You look at a monthly chart of the UUP, and that has been in basically an uptrend for about a year and a half now. So I don't ask questions why, and I don't try to focus on what the Fed is going to do with interest rates and how it's going to impact it. I'm just looking at the trends here, and the U.S. dollar has just been in a significant uptrend for the last year, so I'm not going to argue that. In return, that typically weighs in on commodities-related names, so your energy stocks and your steel stocks and and the whatnot are just going to be really underperforming names here, as evidenced by trading in downtrends below their 250-day moving averages. So real simple stuff here, but again, I wouldn't be going after the hardest trades, which are usually picking bottoms and picking tops in stocks. Just find the trends, find the relative strength and weakness, and take advantage of that. And this is all from like a shorter term swing trading, perspective for the most part. So that's my approach. So.
All right, gentlemen, were there any themes that we might have forgotten about or got pushed aside? Was there anything else that anybody wanted to bring up before we sign out for the day?
I guess the one thing that I would add is we really didn't talk about the U.S.-China trade war at all, and that obviously is the primary driver of short-term sentiment. And you know where I stand on the situation, but I just kind of want to reaffirm that our talk from a few weeks ago is, I would say broadly coming to fruition of this gradually becoming that next worldview of something that's going to be sort of indefinitely with the market. And it's all about how the market is able to try to understand how to value things in a world where we continue to ratchet that up and that there's no resolution, and it's become politically palatable for leaders on both sides to continue to nurse it along. So I don't think that you're going to see any hope whatsoever of a deal at the upcoming G20. And I think that there is a possibility that Gavin suggested where it may be somewhat like November. And again, yes, the Fed's in a different position, but we may see people who are out of the market or overhedged, don't have enough exposure, start to get a little bit nervous that a deal could be announced and that they're not exposed enough, and that could set up a new short coming out of the G20. So I think that we're in a situation where I would continue to hold the same view that I've held at this point, that there is no chance of a near-term deal, and that should be your bias, and that it can introduce trading opportunities.
And we should remind everyone that will be at the end of June. So guess what? That gives us a to be continued for our strategy meeting for next month, because we'll be talking all about that.
With a small caveat to that, Jim, because the finance minister G20 meeting is a couple weeks before, and that people want to see something maybe not concrete, but some innuendos of a meeting between the two world leaders starting to emanate from that early, because the finance minister's meeting is usually viewed as the volleyball setup for the spike for the leaders, and where most of the groundwork's done. So we got to keep that in mind. That's June 8th and 9th, I think.
All right, June 8th and 9th. So that's a good heads up for what we have going on. And then the big G20 meeting will be at the end of June, June 30th, I think. Is that correct, Gavin?
June 28th to the 30th, I believe. I don't have the exact dates on that. In my week ahead that I post tomorrow, I'll be doing the normal monthly June look ahead, and I'll have all those dates lined out.
All right. Well, we'll certainly be on the lookout for that. And gentlemen, thank you so much for joining us. This is always an educational segment. We do have it recorded, and so therefore, if you missed anything, you'll be able to get caught up on everything that our trading team had to say. And just want to say thank you guys for taking some time out and doing this with us.
No problem at all, Jim.
All right. Thank you guys so much.